This is Natalie Pace, and thank you for joining me for my 2026 Crystal Ball video conference. We're going to be covering a great deal of ground. We're going to talk about what I see in my crystal ball for stocks, for bonds, for real estate, for AI, for data centers, for oil and gas, for clean energy, for copper, for gold, for silver, and much, much more. So stay tuned and we'll get started right away. Okay, let's get started. And we're going to start. I want you to know where you can get more information, dive a little bit deeper on everything. So, I do have a crystal ball blog. It's not the most recent one. So, if you go to nataliepace.com/blog, you're probably going to end up with this one, which was on EVs. And I've had a number of other ones since then that we'll be referring back to. So the easiest way for you to access the Crystal Ball blog is either go to nataliepace.com/blog and just do a search for Crystal Ball, use your find function on your computer, or you can email info@nataliepace.com. So a lot of the things that we're going to be talking about today are actually in the blog itself. I have other blogs that dive down the rabbit hole even deeper. So this is just kind of a survey of various things. I'm going to start with my crystal ball on gold and silver. I was reading a research report from Goldman Sachs recently, and they were calling gold their favorite precious metal. So we have seen that silver far outperformed gold last year. So gold was a big performer, but silver was a super performer. Now we have been leaning into silver for a number of years because it used to be undervalued. I'm going to continue to lean into it because gold and silver tend to run in tandem. And while the central banks are still stocking up on gold, they are liking that as a diversification strategy. The U.S. dollar is still very dominant on the world's currency, and gold cannot, necessarily replace it. But it is a good diversification strategy, and many of the central banks are considering that. So we are seeing strong buying from central banks. We also are seeing more buying from ETFs. And again, this is all positive for silver as well. Silver is one of the hot slices that we keep featuring in our financial freedom retreats, and it really has paid off big. So this was a blog that I did a few weeks ago. And again, as you can see here, First Majestic Silver, which was an individual company I featured, is one of the top performers. McEwen Mining, which is rich in silver, gold, and also copper, is one of the top performers. But there's silver itself, just our SLV ETF, a doubling, right? And again, that is a lot more than gold, which was up extremely amount, 60%. This was another great performer as we listed EPU, which is our Peru hot slice or mid-value replacement. And that is because they are the second largest exporter of copper, and copper prices are extremely high as well. So, when we're thinking about gold and silver and all of the metals, they are, very strong right now for various reasons. Gold and silver are strong because central banks want to diversify their portfolio and not be so reliant on the US dollar. Also, people like them as a safe haven, especially when, it's interesting because sometimes we see gold and silver languish a little bit because people say, I'd prefer to have crypto as my safe haven. But then other times we're seeing them go back into gold and silver, especially, and I'm going to lead into talking about crypto. This is not the only trend in crypto, but it's a well-established one that we should all be cognizant of. And I do have a blog that will talk to you a lot more about it, and it also will include, additional information on it. So, Are We Headed for Another Crypto Winter is the name of the blog. It's from the end of November. And again, there's going to be a lot of information there and also about the halving event that I'm going to be talking about right now. We have seen a very strong correlation with Bitcoin halving events. And usually the year after the halving event, so the halving event, most recent one was in April of 2024. The year after is usually when Bitcoin hits an all-time high. And a lot of crypto does follow Bitcoin. It is the most widely traded crypto. 2 years after the halving event is very often a crypto winter. So this is an important trend for us to be aware of because the last crypto winter, we saw Bitcoin hit 69,000 was the high, and then the low was in $15,000 range, and it can stay there for a while. So again, I did do a little graph here on what the crypto winters can be like. And the next halving event isn't until mid 2028. So if the current cycle follows previous cycles, April of 2026 could start a crypto winter. We could start seeing one this year. So anybody that has a boatload of crypto, I would just say, again, the reason that we use the pie chart system for our HOTS, including gold and silver and crypto, and even all of our at-risk investments, and why we rebalance it once, twice, or three times a year is that that helps us to capture gains and keep the money. Then, instead of riding through or freezing our butts through the crypto winter, we could actually buy more low. And that is going to be put us on the right side of the trade of crypto rather than, boom and bust. All right, so let's talk also. I think it's important to talk about stocks because they just hit another all-time high. And this is important to realize. Again, for many of us, it's just a good idea to capture gains. So when we talk about rebalancing, I always say the end of December after the Santa rally is a great time to rebalance. If you're just doing it once a year, do it at the end of December or perhaps at the end of April when you're doing your taxes anyway. That's after the spring rally. If you want to do it 3 times a year, add in the end of September. That's the worst performing month historically on, sometimes it can be buck the trend, but that may be back to school stock sales. So again, buying the pie chart system with rebalancing once, twice, or 3 times a year is a buy low, sell high plan on autopilot. It takes the emotions out of the decision making. All you need to do is have an age appropriate plan that is diversified on the at-risk side into 10 slices, small, medium, large value growth, 4 HOTS. We're using value replacements. I'll talk a little bit more about that. And then you're rebalancing. The slice is too big, it's saying sell high. The slice is too small, it's saying buy low. So that's a time-proven 21st century plan that earned gains in the Great Recession, the dot-com recession, and has outperformed the bull markets in between. And anybody who's been following our strategy throughout all of 2025, you know that we had major hot performers well above the Magnificent Seven. You hear everything about AI and data centers, and not quite as much about Peru, which was 68% gains. Not you had a lot about gold, not as much about silver, which doubled and was way above the performance of gold. So these are important things to realize. I want to talk about the midterm trend. So midterm elections can be problematic. Let me show you a chart. I believe I've got it here behind this. So this is the election year trends. I just updated it. So this is with new information provided by the S&P Global. And as you can see here, midterm years over the past 10 years have not done well. And part of that reason is that 2022 was a really bad performer. It was minus 20%. In terms of the Magnificent Seven, it was even worse. Tesla was down 67%. Bitcoin was down 67%. The ARK Innovation Fund, which included a lot of the Magnificent Seven, down 67%. Nvidia down 50%. Now, there was no recession technically in 2022. There is no recession predicted in 2026. In fact, they're saying that in terms of GDP growth, it's supposed to be a little bit better than last year, which was surprisingly better than expected, partially and mostly due to AI. and data centers. So what I would just say is, again, your best friend is always going to be age appropriate, properly diversified plan. And for most of us, if we haven't rebalanced in the last year, it's going to be capturing gains at an all-time high in a boatload of industries, AI, most of our growth funds. And again, it's really important to have growth funds because if you just have like a target date retirement fund, you're not invested at all in the Magnificent Seven. And some of them even lost money over the last 5 years when the S&P 500 more than doubled and the Magnificent Seven is way up. I mean, we've seen 10 times gains in NVIDIA. So copper in Peru, I did do another deep dive analysis, and this is a recent blog that I just did. Again, I'm going to be including all of these in my, I think, where's my Peru blog? It's probably dividend strategies. Oh, there we go. Okay. I'm going to be including all of these links in the description section of the YouTube description, not in the Substack one. So be sure that you go over to YouTube so that you can get those links if you want them. Or, of course, you can always email info@nataliepace.com to get the links. So Peru is hot. Copper is hot. It's expected to continue to be hot. Part of the reason is that the demand, both in terms of clean energy, because data centers and AI require more energy, and a lot of that is copper is a great conductor of electricity. It's got many other tools, but it's also an essential component in the batteries and in the electric vehicles, which are also increasing in demand as well. And demand is expected to be much higher than supply. Now, we've also, and this it relates to our Peru because we have been investing in Peru. And this is also a good reason why, even with something like Peru, where copper is supposed to remain high, that you do want to capture gains. And the reason for that is that Peru is actually experiencing some social unrest. In fact, some of the copper companies that are located in Peru actually had to suspend operations due to some of the work, the labor strikes and the strikes that are preventing access to the mines and etc. They're calling them illegal, and it's just a little bit of a problem. So I do encourage you to read the blog because it does add a bit of risk to the area. Obviously, the Peruvian government has every incentive to continue allowing operations in these copper mines because their economy is heavily reliant on the price of copper and, of course, the exports of copper, that their country is number two exporter. So it does add a little bit of risk to it, and it still is very hot. All right, I also want to talk a little bit about AI and data centers. They are expected to continue to explode. One of the things, though, is that they're very expensive. They're very overvalued. So again, there's another reason why stay invested in the Magnificent Seven. We have an extra hot slice of Tech B, TECB, which is an iShares ETF that's heavy rich in Magnificent Seven, in addition to large cap growth. If you don't have large cap growth, you're not exposed to Magnificent Seven. So that's another reason. So we have actually two slices that are heavily invested in Magnificent Seven. But if you have invested in them, then you're in a position to capture gains right now. And I still would do that because they are very expensive. And as a reminder, when stocks go down, the Magnificent Seven is the one dragging them down. They go down much faster. So we did see in April of 2025 that stocks in general went down 20%, and yet the Magnificent Seven was down, almost double that. In fact, you could have purchased NVIDIA for under $95 a share. So it's just important to realize that rather than riding a roller coaster, when you see your slice too big, go ahead and capture gains. Don't do it obsessively. Don't do it every freaking day. Do it once, twice, or three times a year strategically at these moments, right? Oil and gas is expected to stay under $70 a barrel. Some predictions are even under 60 a barrel. This has a lot to do with the increase in electric vehicles as well as global uncertainty. So the global economy is slowing down. More people are driving EVs that do not require a visit to the gas pump. I will say that a lot of these oil companies are increasing their production of plastic and polyester. Those are oil products. So this is important to realize. I'm hopeful as an environmentalist that we will all understand that it's not a good idea to cover our food and bodies in plastic products like plastic and polyester. However, most people are not aware of that. Clean energy is increasing. It was a big surprise, especially in the last quarter of this year. And that is because a lot of the data and the AI centers, have strong commitments to net zero in their CO2. So they are investing in clean energy sources for their massive energy demands. Also, China has a big commitment to clean energy. Obviously, a lot of those incentives have been completely gutted in the United States. The current administration, especially the energy department, is run by oil and gas men. So they have withdrawn us from everything clean energy. But that hasn't stopped clean energy from increasing in value and more solar projects and more solar generation, because a lot of those are handled either at the state level or the community level, or as we're seeing at the corporate level. Real estate was a major underperformer in 2025. It is not expected to perform well this year as well. It was only 2.5% returns on average for the entire sector. Commercial real estate is a real problem. And this is one of the reasons why even some of our financials are a little riskier than people realize. It's one of the reasons why we're leaning into Australia for our large cap value instead of the US. Australia has, as a country, a higher credit rating. A lot of the banks have higher credit ratings than US banks. So I would just encourage you to be mindful of that. Additionally, when we're talking about bonds, and I did do a recent 2026 bond strategy blog that you definitely want to check out, we still have a massive amount of credit risk and a massive amount of duration risk. What that means is that if you don't know what you own in your bond portfolio, you may be sold into long-term bonds that immediately might become very much illiquid and have a paper loss. Our bond strategy does not have any paper losses. It hasn't had any paper losses since 2012. In fact, between 2012 and about 2017, we said, hey, you're not getting paid to take on the risk of bonds. They're earning 0% for the high quality ones. And if you want to get a decent return of 4%, which is pretty low, you have to go into junk bond territory. So we said buy real estate instead. And that, of course, doubled. So again, we're always going to be very mindful of how you can keep your money safe without the loss of principal. Paper losses are far more problematic than you're being told. And I strongly encourage you to know what our bond strategy is. It's changed a little bit because interest rates have gotten cut, but we did find some good ways of still maintaining at least a 3.5% yield with no paper losses. Additionally, we're happy to share the bond masterclass with you if you are registering for either our all access pass or the next retreat. Our next retreat is January 17th through the 19th of this month. It's online. And we also have a rebalancing masterclass this Saturday online. It's all day Saturday, 8 to 4 Pacific, 11 to 7 Eastern time. So if you register for the retreat or want an all access pass, please let us know if you'd like to have access either to the rebalancing masterclass and or the bond masterclass. All right, so I'm going to stop it here for a moment and I'll go ahead and take a few questions if you guys have any. If obviously if everybody needs the answer, I'll come back and add it. Okay, so this person is asking me if they wait until January 30th, is that a bad idea? Because I say, okay, if you're going to think about dates to rebalance, think about the end of December, which would be early January. Think about the end of April at the end of the spring rally, could be early May, or think about the end of September or early October, right? So what about the end of January? Well, there's a couple things I want to say. First of all, here we are, and it's January 8th, and stocks just hit another all-time high. Let's take a look at the monthly trends. So, I had shown you that chart of the election year trends. Here's the monthly trends. So, we have seen that January is not necessarily a fantastic performer. So, there's not a great deal of reason to wait till the end of January. And we have seen that historically, February is a downturn. So, what I might do if I were in your shoes, and especially, I know a lot of you guys are dollar cost averaging too. So you're like, I want a dollar cost average when the price is low, and I want to take capture gains when the price is high. I might go ahead, your coaching session with me is at the end of the month, but I might go ahead and mock up my pie chart, my holdings pie. Remember, you always mock up your holdings pie chart and your sample pie chart. If the slice is too big, I might go ahead and capture my gains now because we know that stocks just hit an all-time high just a few days ago. Nothing wrong with that, right? And then go ahead and think about, okay, we'll adjust the dollar cost averaging for the slices that I'm filling up at the end of the month. So I would be an and person.
Okay.
All right, so again, you're going to be able to watch this back at youtube.com/Natalie Pace. You can listen to it on Substack at Natalie Pace. I do encourage you to subscribe to both so that you are always getting a ping whenever, I'm doing this at least once a month, oftentimes twice a month, usually not more than once a week. But you'll get a notification whenever something new comes up if you're subscribing to it. So that is a good idea. It's free, so share it with your friends and family. If you have any money triumphs, any money challenges, anything you think is super hot that you think is not on my radar, I'm open. And especially if you get a hot tip about something that you really seduced into. Sometimes those can be a complete scam and we want to hit and do an investor alert right away. Other times they might actually be an opportunity, right? So email info@nataliepace.com. We are here for your money challenges, your money triumphs to help you save thousands of dollars annually with smarter big ticket choices, and more informed choices. We're going to take you on a magnificent adventure that you can learn more about sustainability and also stay in a royal manor house. Hard to do on your own, a private exclusive experience. So we have lots of different opportunities. I encourage you to reach out and learn more about all of them at info@nataliepace.com or nataliepace.com. Also, I have a brand new 2026 21 days prosperity and abundance video coaching free. You can access the playlist on either Substack or YouTube. And I just updated the ABCs of Money for College second edition. The print edition should be available within a week. The ebook is already available. It's only 99 cents. So any parents even if the baby was just born, it's a very good idea to get this book to them. Thanks again, Natalie Pace. Thanks for joining me, and I'll see you at the next one, which will probably be an interview with a sustainability expert. I have two on tap over the next 3 weeks. Thanks again.